What's going on, y'all? Welcome back to the Mining Pod. We've got a news roundup coming at you fresh with Will Foxley, Colin Harper, and special guest Haley Thomson, Director of Energy Trading at Luxor Technology. We're going to be covering a few news items, also talking with Haley about 4CP in Texas right now. But for the top of the show, got the network update as usual. We've got a story on Antalpha's Q1. Pretty stellar Q1. Loan book is growing fat. And it's the first time we've had quarterly financials from the company since it went public in May. And then we've got, like I said, Haley's segment on 4CP. We're going to be getting into the share of public miners' hash rate hitting an all-time high, at least according to JP Morgan last month. And corporate treasury strategies, are they a bubble? There's some nuance, but also getting kind of weird out there, guys.
Getting
and
weird.
On that note, for the Cry Corner, Semler Scientific trading close to 1 MNAV. Now, what we like to see, it's getting a little crowded, but we'll hop right into those. But first, a word from our sponsors.
Today's show is brought to you by Fractal Bitcoin, but we'll learn more about them later in the show. For now, let's get right into it.
I want to take a second and talk about Colorado Air Filter, a new sponsor for the Mining Pod and a major supplier of air filtration systems for Bitcoin mining sites. Colorado Air Filter is currently running a summer sale on their inventory. From Mervate pleats to HEPA filters, shipments to installations, containers to retrofitted buildings, Colorado Air Filter has it all. Here's what one recent major miner had to say about working with Colorado Air Filter. Working with Keith and Colorado Air Filter has been a seamless experience from day one. Their filter media consistently meets the demands of our Bitcoin mining facilities, ensuring reliable airflow and equipment protection. Keith is responsive, knowledgeable, and understands the unique operational pressures in our industry. We value both the quality of the product and the outstanding service they provide. Units are ready to sell. Contact sales at coloradoairfilter.com using code MININGPOD to claim 15% off today. Again, that's sales at coloradoairfilter.com with code MININGPOD.
Alrighty, and we are back. We do not have difficulty weatherman Matt, but I will do my best to fill in here.
Difficulty weatherman Colin's pretty good. We got two really good options, QB1, QB2, both great.
Yeah, so we'll go over this real quick. Not too much in the forecast. The estimated difficulty adjustment, though, is coming in at -5. We're about 38% through the current epoch, so that is going to shift quite a lot. Hopefully, though, we'll see that go more to the downside. The last difficulty adjustment was just in the negative territory at 0.5%. So miners getting a little bit of reprieve, not too much though, because Bitcoin has been treading water just above 100K. It's kind of funny to hear myself say that, but it's true. And hash price is just above $50 per petahash per day as a result. And network hash rate kind of just bumping around. I mean, it's at 880 exahashes a second on the 7-day right now. Sure, we'll be covering this in your section, Haley, some of those oscillations that we're seeing, because they're only going to get worse, I would imagine, as we go through the summer. But that's kind of it. Don't know if y'all have anything to add.
I'll throw something in there. I was writing for a tweet thread. I was putting some elbow grease into a tweet thread. I was looking at hash price over a 1-year period. And looking at it now, I throw it up on the screen for those watching on YouTube or CoinDesk TV. And you can see that, it's around the same place as of 1 year ago, right when the halving hit, I think, 2 months after the halving happened. And so for miners who have been kind of like existing within this banded range, it's probably annoying, but also consider looking at the 5-year where it's just completely down to the right? So like maybe a little silver lining here is that the last year it's kind of stayed within that banded range and a little bit easier to operate within that. Haley, any thoughts from your side? We can also save some for your segment, of course, but curious, any thoughts from this data?
Yeah, so I mean, the short-term volatility, especially kind of what we're seeing at predictable times of the day, like that is definitely driven by kind of some dynamics in the Texas market that we'll speak to. In terms of the long-term chart, I mean, like my preference, I like looking kind of at the unit, like machine specific for a longer term, or like energy adjusted in many ways, because if you look at the long-term chart and you just kind of like, it's always going to be this race to zero. Whereas if you kind of look at it from what miners are actually making, given the assumption that they have the kind of the state of the art machines, or that they bought, or that they've got a more modern fleet. I don't think it looks as bleak, or it just tells like the true picture of what it's like to operate, and basically the how long you can kind of get a nice return out of these machines. That's the chart right there. So this is my favorite long-term chart because it's a lot more stable. And it just kind of really like digs into the true economics that miners are receiving. So if you look at those high hash prices early on in basically the history of mining, they look amazing, but then you have to understand that the efficiency of the machines wasn't very high, and then of course the higher efficiency machines comes out, it grinds difficulty up. But this chart I find really stabilizes it, and a big shout out to Ben Harper, who kind of put this together. But I think this is one of the best mining charts out there in terms of understanding the economics.
Love it. I have not scrolled over to this new chart. I've seen some of the stuff Hashrate Index has had over the years, so I've not seen this one specifically. So cool to take a look at it. We will keep moving along. We're going to go over to this Antalpha story, which we actually popped out from us over here at Blockspace this week. So I'll pull it up on the screen for those watching. Antalpha Q1 grows lending book to $1.77 billion as Tether nabs 8.1% stake. We go on to write that Antalpha opened up with the strongest quarter yet. As Colin noted at the top of the show, this is their first quarterly filing since they IPO'd. They IPO'd on the NASDAQ May 14th. Antalpha is a fintech firm that's mostly known for its Bitcoin mining financing options. So they provide financing to Bitcoin miners and, as we see in the filing, increasingly other sections of fintech as well. So dive into this article with us. You'll see like a few different areas that they're trying to grow into for the financing book. The largest percentage of their book in terms of financing is Bitcoin-backed loans, which we've talked about time and time again on the podcast at this point. Riot has a Coinbase-backed Bitcoin-backed Coinbase loan out the door right now, and we've seen a few other companies do that over the last, say, 6 months. I think CleanSpark is also has one as well. I want to throw this one over to Colin. Any high-level thoughts on Antalpha coming to market? Tether is a big part of this.
Yeah, it'll be really fascinating to see just how much the market values a Bitcoin lending company, right? I mean, the Antalpha is pure play fintech for Bitcoin companies, specifically Bitcoin miners. And there aren't really any good proxies. You can look at Galaxy Digital's financials, but their loan book is only a portion of their business. It's a good chunk of their revenue, but it's not the only thing they do, right? We'll have a kind of a cross comparison piece coming out in the newsletter next week on that. But I'm just curious as to like how much people are going to value something like Antalpha, because this really didn't have too much fanfare upon IPO, right? I think the market cap right now is bouncing around like 300 million or something like that, which is roughly about, they got what they were asking for their IPO price, but it hasn't really done anything after that. It's just kind of been an underwhelming IPO when you look at something like Circle, right? Which just blew everyone's expectations out of the water.
Yeah, it might be a little unfair to compare them to.
Yeah, I know. It's definitely unfair to compare them. I was just thinking, after I said that, I was like, yeah, kind of apples to oranges.
just threw them under the bus. To be fair, though, like you are operating in a space where there's only like this grouping of people who are going to invest in crypto-related equities. And so that's the problem with mining stocks year to date, and maybe even going back to last year, is for the investor class that cares about this stuff, there's shinier toys. And we'll get into that at the end of the podcast, because the recent shiny toys are now having problems themselves, right? And like now Circle is the interesting toy all the money is running towards. So I think you're right to bring that up in a general comparison, that like Antalpha, really strong loan book, definitely has a lot of connections with Bitmain. You'd think maybe you would have like a bigger splash. I'm going to pull up the chart in a second here, once I can pull it up on Yahoo, but it's down 6% over the last week or so. But I wouldn't say there's like anything super interesting happening with it right now. I think for us who really like covering these stocks, it's just about like, okay, what are they actually doing in the ecosystem? Who are they lending to? Is it East versus West? Who's like actually kind of growing in their book? Those are the questions I'm curious about.
Going back to something that you brought up, Will, and then we'll hop to the next story about where their loan book is coming from. If you look, I don't have the numbers in front of me right now, but if you look at their 2023 versus 2024, they lost a lot of business in the Americas in 2024, or rather, the percentage of their loan book was way overweighted Asia versus the Americas for like last year. And I can't help but look at this IPO in some ways of being an effort to try to reshore that business up. I don't know how much, what actual tangible benefits there will be for them for being public in American markets, like on the NASDAQ, right? But maybe that helps with trying to attract some of these Western mining companies and these Western clients back. So,
I mean, I'll add on to that. I think the short answer is Bitmain, right? So Bitmain has been sort of, in a very general sense, kind of spinning off parts of its tentacles, if you will. So with the Kango spin-off recently, Colin's doing some great little finger motions on screen for those listening. But it's kind of like a giant octopus. They have like probably the biggest company in Bitcoin mining, if not definitely the largest. We don't have a valuation on them because they're private. But the spin-off Kango, which was like their North American Hashrate, and that's growing. This have Antalpha, which has really large ties to Bitmain, and that's like a lot of the financing stuff is now going to roll through there. And then Antalpha and Kango also have a very tight relationship through a few of the back-end entities as well. So I think that's the larger, more important thing for me. Zooming out of this, it's less about the performance of Antalpha or Kango and more like, okay, what is Bitmain doing to like protect its interests and offshore some of its business lines to different parts of the world where it's going to be a little safer if they can kind of land the plane for it. Miners, are you ready to earn more with what you already have? That's what Fractal Bitcoin is for, scaling Bitcoin with Bitcoin using a fully compatible recursive design. In just 7 months, Fractal's hit 18 million users and nearly 2 billion transactions. Fractal's cadence mining reduces up to 50% of your pool fee. No new hardware, no extra energy, and it's easy. FB rewards go straight to your existing Bitcoin wallet address. Over 90% of Bitcoin's hash power is already merge mining Fractal. Get more from the same resources. Start on Fractal today.
Next story.
Yes, I think we're going to throw it to Haley to get an update on the ERCOT trading markets.
Awesome. So right now in the ERCOT market, and so for anyone who's not familiar, ERCOT is the main grid for Texas. The T in ERCOT stands for Texas, and it actually our estimate is that around between 15 and 20% of the hash rate of the global hash rate is currently in Texas. So official estimate is 17.5%. So it's actually very significant. And what we're seeing right now and we'll keep seeing from June to September, it's a market dynamic, or I'll call it a market dynamic called 4CP. And I'm sure people in mining have heard about this a lot, and maybe they don't know what it stands for. Maybe they know too well, but it stands for 4 coincidental peaks. But the idea here, and I think it's like a broader topic, is, and this happens a lot when mining kind of enters the power trading space, is that there's been markets and a design that's existed for decades and decades. It's battle tested, and it wasn't meant for Bitcoin miners. It wasn't meant for the idea that load was price responsive or discretionary or even flexible. And basically that the whole grid and the markets were designed around the idea that the demand for electricity, I'll use the word inelastic, but it basically means that they'll pay whatever the price is. So on an economics textbook, the demand curve is vertical, which means it doesn't matter what the price is. I'll turn on my air conditioner at whatever the price is. And what we've seen with Bitcoin mining, and then even to some extent, some high performance compute, is hyper flexible price responsive load entering these markets and realizing that, and that's not the case. They're not a vertical demand curve. They're saying, well, no, anything that isn't a reasonable power price, and I won't consume. And so they're kind of upending these markets, and there's market design that never expected load to participate and essentially to participate like light generation. So what happens in 4CP is, again, it's a decade-old problem of, okay, obviously a society, especially a top 10 economy in the world like Texas, not only do they need a grid, everyone needs a grid, they need a good, robust reliable grid, and it's pretty unreasonable that the lights would go out in any advanced economy. So, but who pays for that? Who pays for the grid? And that's a question kind of that is universal across the world, and everyone's going to approach it differently. And so in North America, the solution is that load pays for the grid. The people using it, the people depending on it and pulling electricity, they're the people who kind of have to the overall the billions of dollars of costs of building and maintaining the infrastructure. That's who pays for it, and that's pretty fair generally that the people using the electricity should pay for the infrastructure. But then even getting into that, it's like, okay, but how do we allocate the cost to load? Do we do it based on their nameplate capacity? Do we do it based on their average usage for the year? How Texas does it, or how ERCOT does it? It's you get charged your usage, your pro rata usage compared to other users for the 4 highest peaks in the summer. So the highest 15-minute window in June, July, August, September. Those are your 4 coincidental peaks. And so that's the mechanism. It's not even a market. It's the mechanism of allocating billions of dollars of costs to the people using it. What it does is it creates an incentive. And so that incentive, that if without flexibility, you couldn't, it doesn't matter. You have the incentive to avoid these costs, but you can't do it because you're not flexible enough. But with Bitcoin miners, it's this really cool combination of there's an incentive to avoid millions and millions of dollars of charges on your energy bill, and they're flexible enough to actually do it. And so what you end up getting this where as soon as you approach the peak loads, say of June, all the Bitcoin miners shut off, and they let everyone else be the people who are kind of online during those windows. And what you get is this big flattening. And if you want, I can screen share. But if you can imagine, like that standard low curve is just kind of a nice, a nice curve, a nice parabola. And then during 4CP, it's a flat top, because for about 6 hours, especially on odd days, all the Bitcoin miners don't mine. But the second that they are safe to do so, they turn on. So they flatten the top by turning off early and then turning on as soon as they can. And it creates this very, like, it pops out in the chart of this flat line. What it means for hash rate, with 17% of hash rate turning off for hours and hours, is you actually see a substantial change on the days where there's this curtailment, because 17% of market essentially disappears. And so block times, my colleague Ben was running some analysis, and it'll be worse now, but a week ago, the block times during a 4CP window were a whole minute longer than the block times than the other block times. And that's pretty significant. And that does roughly line up with 17% of the hash rate just evaporating for predictable periods of time. So it's a really cool dynamic. But what I love watching it is because, like, it's undeniable how big Bitcoin mining is and how important it is to this grid. It's also, I think that the 4CP will likely change. This might be the last summer of it, but I think it's a very compelling example that Bitcoin miners need not they can be a solution and not the problem. So here's a market saying we're gonna penalize people who contribute to peak load, who are the biggest users of the grid. And so then Bitcoin miners can just say, okay, well then we won't be that. And they have the flexibility to not be that. And so now they're part of the solution of grid planning. And it's just, so there's no market. This is happening all over the place, that Bitcoin miners are participating in power markets and ramping down and selling back their power. But it's nowhere more obvious than Texas that they can actually say, if the goal is to not contribute to peak load, then we can match that goal. If the goal is to not contribute to net peak load, we can do that. So basically, Bitcoin miners are saying, tell us how you want us to fit into this market, and we can do it. And I think that's very positive for the Bitcoin mining industry. I think it creates a social license to operate. It certainly has the notice of the grid operators, and it's very cool. And I don't know if your users or your listeners want me to get more into the dynamics of 4CP, or if just the high level is what you want to discuss today. But go check out a chart. Go to ERCOT.com and just check out their main dashboard, and you'll likely, if it's a hot day, you'll likely see load is just a flat line. And I can tell you, as a guy who's traded it for a while, that never happened before. So it's where it's kind of unprecedented.
Haley, so just to highlight something from that, you mentioned that miners are being pretty preemptive with this. Like if they know that it's going to be a hot day and they know historically that temperature at this time will cause, prices to spike, are they already planning to like turn off at that time? And they're not even really kind of just like waiting for the moment to come. Like they're starting to really drill into when that might happen and kind of act ahead of time.
So it's honestly, I'd say all the above. It's just like not every family has the same financial strategy that they would give to a financial planner. Not every miner is going to have the same 4CP strategy. It essentially gets into a level of risk tolerance. So you can be very conservative. You can basically just say, okay, I'm gonna shut off within two entire gigawatts of what we think the peak will be. I'll turn off for 6 hours today. That basically guarantees a much lower energy bill. But the cost is, of course, there's hours that you could have been mining, making a positive margin that you weren't. You can I'll say fly incredibly close to the sun, where you're doing everything automated. You're leaning on the flexibility. You know that your facility can be shut off within 2 minutes. So you're going to get like right up to the last peak before you shut off. That's a very aggressive risk-seeking strategy. You're just more likely to accidentally be running during that window. But if you can pull it off, then you make more money because you basically reduce your downtime while still hitting those windows. So it's the higher your performance is, the more risky you can be.
Just to jump in here and zoom out a little bit, Colin and I talk a lot about how Bitcoin mining is going to like impact AI data center builds and just like typical consumer electricity. For Texas, that market's just fascinating to watch because it's not only mostly free and open on the generation side and then wherever you want to plug in, but also because Bitcoin mining makes up a sizable percentage. Based on ERCOT estimates, what's the latest size of Bitcoin mining and a percent-wise on the Texas market? And how much of a stake do they have when it comes to talking to ERCOT? You mentioned that previously, that ERCOT is liking what Bitcoin miners are doing with this. But the percentage and then like the interest from ERCOT to work with Bitcoin miners, I'm curious about that.
So there was undoubtedly 2 gigawatt last summer. This was a dynamic last summer. Undoubtedly, it was 2 gigs of flexible load was participating. I'd say this summer it's closer to 3. To the full extent, everyone who's been energized, I cap out at 4. It's not all known or all public, but guaranteed 2 is hyper flexible. I'd say it's closer to 3. So ERCOT's peak load is about 85 gigawatts. So we're only talking about 3.5% of the peak load. That they're going to be a bigger part of like overall average load because they're consistently on. But that is still absolutely, it sounds like a small number, but that's an absolutely massive number in my opinion. I mean, Texas is a top 10. If Texas was its own country, it'd be one of the big top 10 GDPs in the world. And this is their grid. So for that to be 3.5% Bitcoin mining, that's something. I would say like Texas is really good at being generally, not always, generally they're really good at being technology agnostic, where they treat generation as generation. They treat storage as storage. They don't go in there and say a lithium battery is good, but a lead battery is bad. And they're and this is actually something you really want in market design. And so their terminology around, I get upset whenever I see someone try to codify like cryptocurrency mining, and you see it in legislation, and it is just what is cryptocurrency mining, right? Like okay, I got a GPU, it's mining, it's mining a shitcoin. Well, that's cryptocurrency mining. Now it's doing AI. Well, that's not cryptocurrency mining. It's the exact same infrastructure and the exact same equipment. So like that's bad legislation. What Texas is really good at is using terms like flexible load or price responsive load, large flexible load. And so that's kind of what they'll bucket any load that can perform. And then they'll say, well, what's large flexible load? Well, it's a load that's this big that can ramp down or ramp up within this time frame. Now, a refinery, anything can technically be this. And so they do a really good job. Now, that being said, they know it's Bitcoin mining. They know Bitcoin mining is the most performant version of this, but they do kind of approach it in a way where they don't single out an industry. To the extent that they do single out an industry, shout out to Lee at the Texas Blockchain Consortium. They do an amazing job. They're kind of like a lobby group for the whole industry. And so I think the big miners are talking to ERCOT directly, but there is this very, very active, very competent, very engaged group in the TBC, and they advocate on behalf. Luxor is a member of the TBC, and they advocate on behalf of the industry, and I think they do a fantastic job.
Awesome. Hey, Haley, thank you so much for that segment. We're going to keep moving along. For those interested in this, they can go to Luxor or go to Hashrate Index. You can find links in the show notes. Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin. So we're going to keep bopping along and move over to this report from JP Morgan that our friend Reggie actually wrote along with another member of the team over at JP Morgan. We've had Reggie on the show a few times, so definitely go back and check out those podcasts. We'll need to get him on again soon here. Colin, take it away.
Yeah, so U.S. listed Bitcoin miners' share of network hash rate hit record high in June, according to JP Morgan and, as Will said, our friend Reginald Smith. So this is not shocking, I think, to anyone who's been paying attention, but also maybe a little bit shocking considering how many AI pivots there have been in recent months. So I have the actual chart with me right here. So this was shared by Matthew Sigel from Van Eck. This shows the month-by-month breakdown of JP Morgan's data going back to January 22nd, when they started collecting it. And as you can see, it's kind of just been a steady stairway upward. Now, the peak as of last June was 31.6%. So according to the way that JP Morgan is measuring it, I think they take 13 US listed Bitcoin miners, and the 31.6% is their share of Bitcoin's total hash rate. Now, that does not mean that all that hash rate is in the US. I think that's important to clarify. That specifically is hash rate that belongs to public entities that are listed in US markets. So the actual number is probably a little bit higher because he's doing 13%, but those are all of the big ones, right? So, he's not going to be dealing with, some of the public miners that have like 1 exahash or something like that, right? But yeah, I think the one other thing I'll say about this, going back to the AI pivot thing, I would not be shocked if this is the top for this metric or if we're close to it. Yeah. Iron is no longer buying ASICs. It's trying to lean fully into AI and HPC. I think once they hit 52 exahashes, they're done with adding hash rate, at least for the time being. Bitfarms has paused buying ASICs. Riot has paused its Corsicana facility, which is 1 gigawatt. They already have, I think, 400 gigs online or 400 megawatts online, but the other 600 they might use for AI and HPC, or it might retrofit the 400 as well. But you have all of these stories about Bitcoin miners really pressing pause on their Bitcoin mining operations and leaning into AI and HPC. The only big ones left that are not doing this, or at least saying that they're doing this, are CleanSpark and Marathon. BitFuFu is another one, I think, and then Kango as well, who's a newcomer. But they're just doing pure play mining, and they will soon be one of the largest pure play miners. So all that being said, I would not be surprised if this is kind of the top for this figure, but I'll throw it over to y'all.
Yeah, this is January 2022 through present day. So 2.5 years has gone from 14% of the network to well over 30%. And I like the note there on where is this hash rate? It's US public companies, but a lot of these public companies are now deploying in Ethiopia. They are deploying in South America, and they're deploying in Bhutan, Central Asia, things like that. So you'd have to take that into consideration as well. The concern historically in Bitcoin circles for all these things has been, is there too much hash rate on public markets? And could the US government go after these Bitcoin miners because they're on public markets? And there's a range of options they could do. They could just litigate them into the grave, like we saw with a lot of startups and crypto during the Biden administration. That could be like one option. But there's more thoughts on that as well. I think the other part of the equation was how much hash rate is physically in the United States. If, Uncle Sam decided to like drive up to a West Texas data center and put a lock and key on it and yank the internet, it's a little more dystopian, but crazier things have happened in US history. So those were the primary two concerns. And I think that's where this is going to get some traction on Twitter, and other people are going to be taking this and kind of running with it. And like, oh, there's too much hash rate here. Personally, I'm not super concerned about this. I think you're spot on, Colin. I think we've kind of reached an upper bound. If we look at some of the different deployment figures and forecasts for these public miners, which certainly could change, but looking at the major ones, we see that a lot of them are shifting. Bitfarms does not plan on purchasing any more ASICs as of now. Iron, they're not going to expand past that 50 exahash. We've seen that Bitdeer, they are growing in that vertical integration, purchasing those ASICs or making their own ASICs in-house, I should say. But they're also put a notice out for one of their larger sites in Ohio that they're probably going to do AI HPC with, which we haven't had an update on in a little bit, but it's presumably what the convert note was for them that we saw this week. So I would agree with you. I think we're kind of reaching upper bound. There's a few pure play Bitcoin miners out there who are, still running strong with that, and we love it here on the Mining Pod. But I think we've reached an upper bound. I also think, like, just from a technical network standpoint, people get way too concerned about like how much hash rate is in a certain jurisdiction. It would have to be a pretty large amount for that to be a concern. Private property rights tend to be pretty strong in the United States. Haley, I'll throw it over to you.
Yeah, I mean, I think about this a lot. I agree with you. Like, I think we've got a pretty good diversity across the world of where the hash rate is. I think if you're gonna be concerned about this, you should probably be more concerned at the fact that there's size pools. How much hash rate is at a single pool, or potentially the internet service providers. That's another thing that someone told me once, that it's like, oh yeah, there's maybe like 5 companies that all of the entire internet basically feeds through. If they didn't want Bitcoin mining to happen, I'm pretty sure they could find the signature, digital signature, and turn it off, and then maybe we'd all be on Starlink. So there's like, you can come up with an infinite like doomsday scenario. I think the market's always going to adapt. My personal view is we will move away from warehouse mining over time. Like, I love Bitcoin. I'm fully bought in. At the same time, you show me a 1 gigawatt facility warehouse flushing heat sitting next to a hospital, and you tell me, ask me which one of these facilities like should be powered and shouldn't. Like, I think we all know the answer, no matter how much we love
the Bitcoin mine, obviously.
Yeah, the Bitcoin. Yeah, grandma can find a hip somewhere else. But so my view is like a lot of Bitcoin, and that's why, as an energy guy, like my view is essentially vanilla mining is going away. So I think that there's a big bridge of participating as power market, as a digital battery. That'll go far. But my view into the future is people are going to be heating swimming pools. They're going to be doing the flare gas. Like, it's going to get a lot more decentralized. That's just an opinion. But I feel it's, when you look at these massive facilities, that's just what I think when I look at them. And I think it's a lot like looking at what oil production looked like in, say, Texas, or I'm from Alberta 100 years ago. If you went and looked at oil production 100 years ago, there's like big wooden derricks, like basically right on top of each other. And that guy's trying to pull more out of his straw than the guy right next to him. And the whole like reservoir is gonna decline because there's 100 straws poked into it instead of one. Basically, like, just very archaic approach. At the time, it was state of the art, right? Like, at the time, that's just what the industry was. You go look at those same facilities now. It's like one nice little drill pad for 100 acres. Everybody thinks about like the overall recoverable part of the reservoir, and not just like, I need to get mine. I think it's similar. It's like, when we look at it's already matured so much from where it was 10 years ago. Where is it going to be 10 years from now? So, the fact that Corsica isn't going to become a 1 gigawatt mining facility, I like that personally. Like, that's, it probably never should have been. That's my view. It's not maybe going to be a popular view, but I'm almost not against, if honeypots get so big that that's an issue. It's an issue for a lot of reasons, and not just because they're a honeypot, but just because, like, does it really make sense that, that like to put this much of the economy and this much of the power towards these things. When you see all the power that gets wasted in the oil field, or there's applications for heating, Bitcoin miners are they're so ingenious and industrious that they find all these applications. I think those applications are going to go from hobby to mainstream in the next decade or two. But on this, I could be wrong, because if we get another super cycle in Bitcoin, they're going to be plugging out they're going to be pulling those AI machines and putting in ASICs, because they're ultimately, these pubcos are listening to their investors, and if the investors want upside in AI, that's what they're going to do. If they want the Bitcoin upside, that's what they're going to do. So that's who's kind of driving the bus, and so you're just seeing the pubcos respond to their audience, which is their shareholders.
Speaking of shareholders, we should go into the corporate treasury play. I'm going to pull up this article from The Block. I think this piece did a good job kind of explaining the lay of the land, and will actually segue really well into our cry corner for the week. So the headline reads, corporate crypto treasury bubble risks are real, but more nuanced than in past boom and bust cycles, analyst says. So this is one of those classic articles that's kind of going through a report that someone else put out. Essentially what it says is, hey, yeah, there is some fear here and risk of a bubble and then contagion from that, but it's not as bad as it was last cycle. So embrace the ride here. I'll read the top of the article and then throw it around the horn for you guys. A wave of public companies is increasingly transforming into crypto treasury vehicles, raising billions to stockpile digital assets like BTC, ETH, Sol, and XRP that have fueled soaring valuations and bubble fears. But while the risks are real, they're more nuanced than the collapse scenarios being seen during crypto's last boom and bust cycle, according to Presto head of research Peter Chung. He goes on to write, the recent surge in public entities adopting crypto asset treasury operations marks the dawn of a new era in financial engineering comparable to leveraged buyouts, LBOs, in the 1980s, or exchange-traded funds, ETFs, in the 1990s. This phenomenon remains poorly understood outside a small segment of the crypto industry, often oversimplified as nothing more than a leveraged ETF trade. So I thought this one was timely. It's a little slow on the news week for Bitcoin mining. There's a handful of things like the Antalpha piece that we covered, but there wasn't much more. However, there was a lot of talk about the treasury play slowing down. The metric there is MNAV, which we'll get to in a second with this Semler scientific cry corner. These companies are just buying Bitcoin and sitting on it and typically seeing their stock price go up. There is a strategy to make it work, specifically when you are in a jurisdiction that doesn't have access to a Bitcoin ETF, or another way to get Bitcoin on your balance sheet, and a hedge fund wants that. So next best place to buy a company that has Bitcoin on the balance sheet. That seems to make sense. But the downside to all of this is, one, companies taking on dilution or financial engineering to buy Bitcoin, which creates risks and possibly contagion later. And two, a lot of these underlying companies just suck. Like, they're not doing anything that's like actually useful besides buying Bitcoin. So I want to throw it over to you guys and get your takes on it. Colin, you're smirking a little bit, so maybe you have some thoughts for the crowd here.
It's just so lame, man.
Yeah.
It's like, oh, we're going to, issue a bunch of converts or dilute the shit out of shareholders so that we can hoard Bitcoin to shore up our failing businesses. I mean, there's just nothing exciting about it. I keep being told that, Michael Saylor, is a genius. And like, in a way, like, yeah, he did something that no one else did and was doing at the time. And his company is like, $100 billion company at this point, simply from buying Bitcoin. I mean, they have software and services, but that's like, I think it was like 100 million or 111 million in revenue in Q1. So yeah, like, first mover for Saylor, like he did exploit an asymmetry in the investor landscape, and he did figure out the financial engineering to basically like supercharge his stock price. I don't think that means we need 30 of these. And ultimately, I agree with you, Will. It's like, if you don't actually have an underlying business, this is the lamest thing ever. If you're not like the first few companies to do it. Otherwise, if you're an Apple or a Magnificent Seven stock, or even just, a cash flowing stock on one of the public markets that's well known, having Bitcoin on your treasury, to me, sounds like a good way to just supercharge your cash position. But if you aren't actually doing anything and your whole product is just, hey, like, we're a volatile stock because we hold Bitcoin, I mean, what are we doing at this point?
I mean, I don't want to put on the devil. Like I could steel man the case from the other side, but I'm with you. Like I don't know what is so complicated about buying the physical stuff and putting on a ledger, and it's so freeing when you do. I mean, that's a way bigger topic, but like when I go deal with the banking system, and it's like you get asked what you withdraw, and you're just like, it doesn't need to be this way. But the steelman case is like, there's a lot of people and honestly, like a lot of wealth. So like, just don't measure people in like bodies, but just if you measure them in dollars, there's an incredible amount of wealth that's tied into the old system. And like my analog in my life is like my dad. Like I'm never going to get him to buy Bitcoin on an exchange, but for him to be able to click on an ETF or something that he knows is going to move like it, but it's presented to him in his brokerage screen, what he knows, what he's comfortable with. It's held alongside his other securities. And so I'll just use my dad as like an analogy of like, a lot of wealth, maybe not people, because like a lot of younger people are Bitcoin and they have no problem with wallets and what we know very well. But for a lot of people, that's the transition. I think actually the Romans, when they built the Parthenon, they like, it's that famous building, and they have like a hole in it at the top, and that has like some pagan significance. And the reason that they did that is because like they wanted to convert the pagans to Christianity, but they had to like bring them along with something familiar. So that's like the Parthenon has like this pagan architecture, even though it's a very Christian building, because that was okay, we got to convert these people step by step. That's an ETF in my mind. It's like it's how you get legacy finance, people who are like converted to like, okay, there's something here. It's not a scam, but I don't want to like lose my seed phrase and like lose 100K because I don't understand that. I want to click a button where I've always clicked a button. That's my steelman case. And like, that doesn't get into MicroStrategy and the leverage and everything, but just the securitization of Bitcoin, why there should be maybe 30, 70 companies that are doing it, and that's okay. That's maybe my steelman case. It's like, okay, but there's other people who want to get involved, and they're never going to go to Coinbase. So Grayscale ETF, recommended by their financial advisor who they trust, that's the young guy, that's the guy in their 20s or 30s who puts it on their radar, but it's the Parthenon for them. That's kind of how I understand it.
Yeah.
That's my steel case, but do I do that? No. I guess the last thing I'd say there is registered accounts are another thing. And that gets into the stuff that like we love the pure play, but there's people who like the whole way that they approach Bitcoin or even mining is about tax, right? They'll say, actually, you should mine and not own Bitcoin because you can write off all your machines. So you can go and get exposure in your 401k to Bitcoin through these vehicles, but you can't go buy Bitcoin with your 401k. And that's another, I'm a Canadian, so we have different we have different kind of instruments, but it's the same idea. Like, so the extent to which I do hold paper Bitcoin, it's because it's in a registered account that I can't access the liquidity to buy the physical Bitcoin, but I can go buy some paper shares. And that's another big, I wouldn't like I don't think you can overstate how big a deal that is. Like the 401k wealth, being able to access Bitcoin. I mean, that's probably why we're at 100K in part. So that's maybe another steel man on why this dynamic is happening and why it makes sense for companies to do it. If you guys are around for the blockchain stuff, though, it does feel a lot like that. Like,
yeah,
the juice company becomes like juice blockchain, and
Long Island blockchain company,
blockchain.
It does feel a lot like that too, though.
It does. I want to go into the Semler Scientific story as we're getting close to time here, and this was a big one within just like general Bitcoin circles. So we're deviating a little bit just from the mining news, but I do think it's worthwhile. So we'll pull up this story from Decrypt. Headline reads, "Is Semler Scientific flashing a warning sign for Bitcoin treasury firms?" Subdeck, the company was valued at a razor-thin premium compared to its Bitcoin holdings as of Tuesday. So we are recording this as of Thursday. Looking at the numbers, things have not changed too much. Basically, Semler Scientific is a medical device company. They purchased Bitcoin, put on the balance sheet. They have about 5,000 BTC. They did this around the same time. I think Metaplanet did it as well. The difference being Metaplanet is in Japan. Semler Scientific is listed here in the States. There's a little more competition here in the States. There's MicroStrategy, there's Bitcoin ETFs, there's Bitcoin mining companies you can buy. Metaplanet sort of had like a nice barrier just being in Japanese markets. And so that's why Metaplanet's done so incredibly well in a lot of ways, just to boil it down. I do wonder what the future for some of these copycats are based on this. We'll follow up really quick here, and I'll throw it to the group with this tweet thread from Matt Segal. We already mentioned him earlier. Great follow on Twitter. And he just kind of goes through in this tweet thread about like what's actually happening if on the structural part, these companies that like aren't super performant, they purchased Bitcoin onto the balance sheet through equity dilution, through debt, through a convert, something like that. What happens into the future and how do they stay safe and relevant? His thread kind of goes on to say that like it's not necessarily a concern about them falling apart or them causing some sort of contagious risk to the market. It's more about like they're small cap companies. They tried the game, they tried the play, it didn't work out. How do they stay relevant? And he has some thoughts in here, including like, don't pay your CEO way too much just because you got Bitcoin. Don't keep adding dilution to shareholders. Actually make your underlying product a little bit better. Business 101, add revenue. Want to get your guys' thoughts on this. To me, seeing a story like Semler Scientific struggling makes me think that MicroStrategy's already kind of won the game. They have the 5 or so equities with different variants of risk, but different upsides to all of them that anyone who's trying to play this game would want. And unless you're in a foreign market like Japan or was it the Smarter Web company is in Britain, like there's not really a game to play for the copycats. So I'll throw it over to you, Colin.
It's kind of a winner take all thing. I mean, maybe there are a few winners, but like I said earlier, do we really need like 30 of these companies? And the only reason why you might buy one of the new ones, if you're an investor or just aping into these, is that you missed out on the boat with MicroStrategy and with Metaplanet, right? But I feel like the more of these companies that come out of the woodwork, the less likely the strategy is to succeed, because there was novelty for investors to get this high beta exposure to Bitcoin. And then for the companies in the trading desks and or whoever's buying these converts, they have the ability to trade the volatility, right? So they can use the convert as a kind of an option that they can then, exercise and get the stock at a lower price when it comes to maturity, or they're also shorting the company at times when Bitcoin's drawing down. So they kind of make, they're making money on either side of the trade. And if you have so many of these companies in the running for this, I don't know if there's enough appetite to continue fueling that, right? Like, are you actually going to have enough interest from the buy side for the converts? Are you going to have enough investors interested in your stock to kind of keep the music going?
Any final thoughts on your side, Haley, before we close out?
I'm tempted to say no comment. I'll just mainly because this opinion is my personal opinion. This is not a Luxor opinion, but I mean, I would almost say this, just being in the space for long enough, and say, like, I think the lesson in a way is like, don't go public, or if you love your company, if you love what you're doing, like do that thing. Like I've seen companies go public, thinking it's this amazing thing, or it's like, that's the launch, and now they're launched. And then all of a sudden that they realize, oh, we don't control our value anymore. The market does. And our particular shareholders are fickle. And then they start dictating to you what your company is. So if they say, actually, we want you, we're going to drop your shares unless you become a copycat Bitcoin treasury company, then they're more likely to do that. Whereas if they had stayed private, that wasn't their product, that wasn't their mission, that wasn't what the staff signed on for, so that's not what they're going to do. But if you find yourself a CEO of a public company and your share price is getting dictated to you by others, and that's who you work for now, less than you're driving the organization of employees, and you have a mission that you can stick to. Now and so it's a reactionary thing. So like, should they be copycatting, or like, is there any value for them to do so? Maybe not, but they're kind of getting bullied into, like, they've kind of given up some control of their company and are getting bullied into that choice. And so I have some sympathy for it. And so I like, a lot of pubcos are great and they are trying to create value, but there are some that was the exit. The exit already happened. The old organization no longer exists. And now the public one is they're just reacting to what their shareholders want. And the exit, the value, that all got created in going public. That definitely happens. And I think we're seeing a bit of that dynamic where you guys are podcasters. You're familiar with the concept of like audience capture, where like your audience captures you, and like that's not happening to you guys, but like it happens to some podcasts, right? Where like, oh, I guess now I guess this is what I talk about because that's where you get your followers or your likes. I think you definitely get shareholder capture too.
Well, we are very captured by Bitcoin mining. So I will say we're pretty captured. We like the whir and the buzz of Bitcoin mines. So Haley, thank you so much for joining us. As always, you can click below in the links and find out more information about Luxor. And we will see you guys next week. Colin had a great interview earlier in the week, I should say, that you guys should check out with New West on Bitcoin mining in Alberta, so up in Haley's jurisdiction. And then next week, I'll be jumping on the horn with Brandon Bailey of Second Gate to talk about Bitcoin ATMs, one of the most lucrative public companies in Bitcoin people do not think about. This is not at the market issuance. This is actual ATMs. So we'll see you guys next week.